Wall Street looks at this back-office services business and assumes artificial intelligence is going to vaporize it. The market is pricing it for a terminal decline at the lowest valuation in its 9-year history, but they are completely misreading the story. This company isn't getting disrupted by AI. They are the ones selling the shovels. Here is what the panic sellers missed. Genpact does the heavy lifting for massive global corporations. They take over complex, unglamorous processes like customer onboarding, supply chain management, and regulatory compliance so their clients can focus on their core business. The market sees traditional outsourcing and assumes AI startups will automate it all away. What they miss is that Genpact is actively integrating AI into these workflows through what they call agentic operations. They are completely decoupling their revenue growth from their human headcount. Genpact has two main businesses. First is core business services. This handles the standard plumbing for corporations and makes up 73% of revenue. The second is advanced technology solutions, which includes their data and AI work. This segment is now 27% of the business and growing fast. They also pull in about 13% of total revenue by partnering with ecosystems like Google Cloud. The real advantage here is that once Genpact is embedded in a hospital or a bank, the switching costs are immense. You don't rip out your accounting and supply chain plumbing to save a few pennies. They own decades of context-rich process intelligence, which is exactly what you need to make AI actually work in the real world. This is a nearly $6 billion business operating quietly in the technology services sector. Let's talk about what could go wrong. The structural threat that keeps people up at night is that an AI-native startup figures out how to automate back-office work faster and completely bypasses Genpact's legacy model. On top of that, a global recession could cause clients to freeze their IT budgets, labor costs in delivery centers could rise, and Wall Street gets easily spooked by messy accounting metrics. Right now, the market is laser-focused on that first threat. They see artificial intelligence as a giant meteor heading straight for the outsourcing industry, and they've sold the stock down to rock-bottom multiples out of pure fear. But the ledger tells a totally different story. If AI were destroying them, revenues and margins would be collapsing. Instead, Genpact's Advanced Technology Solutions segment just grew 24% year over year. Around 70% of that revenue is annuitized, meaning it's sticky and recurring. And rather than labor costs crushing them, they've expanded their gross margin for 12 consecutive quarters by moving to outcome-based pricing rather than just billing for human hours. Let's calculate the real cash this business puts in our pockets. We start with roughly $644 million in operating cash flow. We subtract real expenses like stock compensation and routine maintenance, and adjust for temporary timing differences. That leaves us with a true cash profit of about $630 million. Divide that cash pile by the share count, and this business is generating exactly $3.70 per share in owner earnings. This is a highly profitable business. They generate a massive 56% internal return on capital while spending just 1.5% of revenue on routine maintenance. They do not need to constantly reinvest just to stay in the same place. The competitive trajectory is strengthening. Their deep integration into client systems creates massive switching costs. Clients aren't firing them. They are actively choosing them to lead their AI transformations, which is why 70% of their tech revenue is recurring. Over the last 7 years, their cash profit has grown nearly 14% annually. Even better, they have expanded gross margins for 13 consecutive quarters. A dying business does not expand its margins for 3 straight years. This is a cash-generating service franchise, so it operates with a net debt position of $897.23 million. We have to factor that debt into our final valuation. Management is actively directing cash to buybacks, spending $265.54 million annually to shrink the share count. I classify these buybacks as accretive because they are buying below intrinsic value, though the net reduction is modest. First, do we understand it? Yes, they handle the unglamorous back-office operations that keep massive corporations running. Second, are the economics durable? Yes, the switching costs are massive, and their process intelligence makes them hard to displace. Third, is management honest and rational? Yes, they are returning capital to us by repurchasing undervalued shares. Finally, is the price attractive? Yes, the market is pricing this like a melting ice cube when it's actually growing. Let's walk through the valuation. We take the cash it generates per share, which is $3.72. We multiply that by a reasonable target multiple of 15, which is fair for a tech services business with strong recurring revenue. We subtract our net debt per share of $5.34. That brings us to a fair value of $50.96 per share. With the stock currently trading around $33.74, we have a margin of safety of roughly 34%. My verdict is a clear value opportunity. The market is pricing Genpact for a decline due to fears of AI disruption, entirely ignoring its massive structural advantages. By successfully offering new AI services, the business is actually accelerating its high-margin tech revenues. You are getting a wonderful business at a significant bargain, with a margin of safety of roughly 34%. Thank you for walking through the ledger with me. Always remember to do your own research, verify the numbers for yourself, and stay rational out there. If you found this breakdown helpful, consider subscribing for more deep value investigations. See you in the next one.